I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. So this is our table pounding technical chart to nail you all. If you're in the stock market or the gold market or wherever you are, this is the most important breakout that's about to occur. And if it breaks out, which it will, this is too persistent, okay? It's saying, I just began. So if you think gold is old, it's just begun its major shift against the paper bubble, the U.S. stock market. Just began. It ain't going to end in 3 months. This is something going on for years. So don't think of gold as being at the end of something. It's just beginning when you measure it versus the U.S. stock market. I'll give you two examples. You only have 50-year history. The U.S. government legalized it, okay, in January 75, okay. Over that time, there have been two major bull markets. And if you measure from the bear low that preceded the bull market to the bull market peak, bear low to bull peak, both moves, one peaked in 1980, one peaked in 2011, were eightfold moves. Not the same dollar amount, but the ratio move. The same dimensionality of price gain, eightfold, bear low to bull high, okay. We're only fourfold. We started from a bear low at 1,050. Multiply times 4, okay? You're a little bit better than half the dimension of those two prior bull markets, which were of different duration, by the way. One was about 3.5 years, one was about a decade, okay? So I'm not counting the years, I'm just saying how much did it move? And it moved under circumstances then that are by no means as dynamic pending as the ones we're sitting on right now. So I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play. They're not evident right now to most people. All they're focused on is AI, you know. But if all of a sudden other factors come into play, especially negative ones, hands go in the air, emotions occur, politics becomes dissembled, which it's already become. I mean, the two parties are fragmented internally, getting worse even on the GOP side's fragmenting. Suddenly, people don't have a sense of, well, you know, it's 52-card pickup. And there's one thing they can rely on, like their granddad told them, keep those gold coins, those silver coins. Okay? Yeah. You know, and all of a sudden, those monetary metals are, again, monetary metals. But as far as I'm concerned, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there. Okay? They don't fix price. They may try to. I mean, there's some solid arguments that they've been manipulating silver. We need to get onto that too. And capped it off for the last 50 years. Well, copper and lead have quadrupled. You know, I'll get into that in a second. And suddenly I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions in that regard. But if you want to, we can get on to that next subject. And you've got the spread chart of silver versus gold.
Silver versus gold.
Yeah. Okay. Now,
what's happening here?
This only goes back to 2020. Okay. So 5 years. We know in early 2020 and to late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to about over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. I'm strongly of the assessment that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already the spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver. Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. Some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners. And you can see back in 2011 through 13, especially in 13, which is where this chart starts, gold was collapsing in price also against the S&P. It was losing value to the S&P. And when gold bottomed in late 2015, that spread reached down to about 50%, that first little circle you see there. And at that point, you can go sideways for 10, 11 years now. And it's been above that level and below that level, but basically par to the S&P. In other words, it's, depending on the point in time you pick, it's doing better or a little bit worse than the S&P, but basically going sideways, okay? Meaning it's not really been as bad as people think. And it's not just recently that gold's firmed. It's at the upper end of the 11-year range right now. But this thing has built a technical base that is so clear it smacks you in the face. It's hit 1, 2, 3, 4 times as of April this year. You bumped that line, backed off again. You're back pressing at it right now. In fact, you're above it intra-month. This is monthly closes. So gold into the S&P. And you close the month where you are now. Divide gold into S&P, it's going to break out. What does that mean? It means that this is a fresh, massive technical base breakout. Treat it as a price chart. If you looked at this and saw it as a price chart, you say, oh boy, I'm going to get on board. And I'm going to buy. But this means buy gold, sell S&P. In fact, you want to go market neutral, buy gold, sell S&P. You put a spread on. But it's also telling you that gold is going to surge versus the S&P. Now, by the way, when we do this same chart, we didn't have it in this report, versus the Dow, or gold versus the New York Composite, both very broader indexes that aren't front-end loaded with a couple of AI stocks like the S&P is. Gold's already broken out. But when this guy breaks out, this spread breaks out, it's telling you as a major asset class shift is underway, it's commencing. Gold is now going to outperform the S&P. So if you invest over spans of time and want the better asset class, it's saying gold is going to lead the S&P now. It's the better place to be. And our assessment is, one, it's going to be the consequence of two things: gold going up and S&P going down. So this is our table pounding technical chart to nail you all. If you're in the stock market or the gold market or wherever you are, this is the most important breakout that's about to occur. And if it breaks out, which it will, this is too persistent, okay? It's saying, I just began. So if you think gold is old, it's just begun its major shift against the paper bubble, the U.S. stock market. Just began. It ain't going to end in 3 months. This is something going on for years. So don't think of gold as being at the end of something. It's just beginning when you measure it versus the U.S. stock market. And again, it's already broken out versus the Dow or the New York Composite. It's about to break out versus the S&P. So this is a very important investment grade technical chart. Some people look at other end. We like that one because it's well balanced. It's not so heavily overweighted in energy, for example. It's got metals, base metals, meats, grains, etc., sugar, things like that. It does not correlate to gold over time. Sometimes it does, sometimes it doesn't. In the late 1970s, it coattailed gold up to the 1980 peak. But it began a whole year after gold had already turned up from the 1976 low. Commodities didn't turn up till 77. And they didn't match the dimension of the gold move, but they followed it. But if you'll look, for example, from 2015, commodities were at a low. Gold was making its bare low then, late 2015. Gold doubled between 2015 and 2020. In fact, it went from 1,050 to over 2,000, okay? During that same time, the Bloomberg Commodity Index ratcheted lower. Didn't collapse, just kept going down. So it didn't correlate to gold. Oil correlates well to the Bloomberg. All the basic commodities you can think of correlate well. Silver does not correlate well to the Bloomberg and commodities. Commodities can have a downward trend and silver go up with gold. Silver correlates to gold. It may lag or lead, but it will be in the same direction. So to make a mistake of thinking if commodities go down, that could hurt silver, no. The correlation doesn't exist. There's very few times where you can find that linkage. But right now it looks like the Bloomberg, which is a very cheap category. It's for the last 2 years after the correction that occurred from the 2022 high when that war started, commodities peaked, okay? They didn't go up because of the war, they peaked then. They dropped back to 100. Well, heck, the high in the Bloomberg Commodity Index in 2008 was 238. Right now we're trading at about 110. We've recently broken out. The October close for us, which was above a key level for us, which is in the 106s, said the Bloomberg is waking up, it's going to go up again. Right now, oil is a laggard, a weak component within the Bloomberg. Copper strong, grains are starting to assert themselves via our momentum metrics, meats are strong, base metals are strong. Oil will follow the Bloomberg. Right now, it's probably in a slingshot position where you're right, it's cheap. In fact, I understand that most companies that produce it really aren't hedging here. They think it'd be foolish to hedge their oil production here at these price levels.